Hello friends, the focus of discussion here would be to look at income taxes and its whereabouts in a bit more detail. Now when we talk about income taxes, we probably look at the income statement, and when it starts from sales till cost of goods sold, EBITDA, EBIT, EBT, and then we have taxes. So let's redraw the income statement for a minute. We start with sales. Let's say sales were 1,000. Cost of goods sold, let's say they were 500. Then what we get is the gross profit. The gross profit is the difference between the two, so that is basically 500 here. After the gross profit comes the operating expenses. So let's say operating expenses were 200, so we get what we call this as EBIT, that is earnings before interest and taxes, assuming that now this is 300. Interest, let's say it is another 100. So what we get is this earnings before taxes. This is basically equal to 200 here, and let's assume that the taxes we need to pay is at the rate of 30%. So 200 into 30% will be 60 here. So what we get is 140, that is the net income. Now when we talk about this taxes, we have only looked at one set of income statement, and I'm sure we have assumed as of now that this is the amount of tax that is due to the income tax authority. Now this was our assumption that whatever the tax that we show through the income statement to the shareholders is the tax that we will pay during that year. Now when we talk about income taxes, I'm going to introduce a new thing for us, that is that there are two set of income statement. One, the income statement which we have learned till date, that is reported to the shareholders, and then there is another one that is reported to the tax authorities. So there's another income statement which may look similar or which may be slightly different. Please note that the income statement that is reported to the tax authorities can be slightly different or totally different altogether. So let us kind of make the income statement of this particular case as it was reported to the tax authorities. So let's kind of prepare some figures here. Sales, let's assume that this was reported as 1,000. COGS, cost of goods sold, was exactly similar, so 500 was reported. Gross profit then in this case came out to be 500. Now coming to the operating expense, now here we'll slightly change some of our assumption. Instead of 200 here, let's assume that this expense was reported as 300. So the first thing that we notice that this number can be different, and we'll see the reasons as to why these numbers can be different. But for the time being, let's concentrate and understand what is the actual methodology behind the tax calculations. So what we get here is the earnings before interest and taxes, that is 200, and looking at interest, that would be 100 here. So what we get is EBT, that is 100, and as we know, tax is calculated at the rate of 30%, so this would be 30. So the net income that gets reported here is 70. So now coming to the actual point, that since this is reported to the tax authority, basically this number which is 30 here is the tax that you need to pay this year. So this becomes taxes payable. This is the amount of taxes that is due in the current year, and this is also called as current tax expense. So please note that it is different from what we have looked at from the shareholders point of view. This is not the taxes payable. Okay, this is not taxes payable. Now I'll introduce you to some of the jargons here, which is with respect to the income statement of both the shareholders and the tax authorities. Now when we talk about the taxes of the shareholders, we call this as income tax expense. Okay, income tax expense. Please do understand this terminology because this is very important and found in almost every annual report. And when we look at this comparable in the tax related income statement, this is called as your taxes payable. So slightly different. So if someone is talking about taxes payable, you must know that okay, this is related to the income tax authorities reported income statement. Okay, then the second thing again important is, what is EBT called here? EBT is called as accounting profit. Okay, this is called as accounting profit. So the profit that is reported to the shareholders, this EBT is called as accounting profit. Okay, on the other hand, when we talk about the IT authority based income statement, here it is called as taxable income. Okay, now another methodology, another terminology that I will introduce you here is that since this is 60 here and here it is 30, so there's an equation that is actually called as an accounting equation. Here the income tax expense, this is equal to your taxes payable plus, with the liberty of introducing another term, I'll call this as deferred taxes. So these deferred taxes could be assets or this could be liabilities. Now let me explain you how much would be the deferred taxes in this context. So here on the left hand side we have this number as 60, income tax expense, this is 60 here. What is taxes payable? It comes out to be 30 here. So the remaining amount that you need to pay over a period of time, so there is a remaining amount because these two don't reconcile, so the difference between the two is actually a positive number and the difference is 30 here, and this is called as deferred tax liability. Why it is called as liability? Because you have shown that you are going to pay 60, but this is the amount which you have actually paid. So the unpaid amount that you're going to pay in the future is called as deferred tax liability. Now you may be wondering that okay, if this number is negative then what? And I'll just kind of again explain you that situation. Let's say on the left hand side, if the income tax expense was, let's say 50 and taxes payable was 80, so what would be this number here? This number here would have been a negative number, right? So you've actually paid 80. Okay, you've shown that you are going to pay only 50 to the shareholders. So since you have paid more than what you have reported to the shareholders, then there should be an amount that would be recovered over a period of time. So this difference between 80 and 50, this here it comes out to be minus 30, and this is nothing but your deferred tax asset. Why it is called an asset? Because since your liability was 50 but you paid 80, so the difference between the two, which is going to be recovered over a period of time, that is 30 here, that is called as an asset. So this sits on your balance sheet as deferred tax assets. Here when we talk about deferred tax liability, this sits on your balance sheet as liability. So we will take an example and see how this really works, but for the time being, for the mechanics of income taxes, there are two things which are extremely important which you must understand. First, that there is a different reporting to the income statement for shareholders and for the tax authorities. When we are talking about making the balance sheet, or we are talking about from the point of view of shareholders. So when we look at the income statement of the shareholders, we see that there is a term called EBT. We'll call this as accounting profit, and the tax associated with the shareholders income statement will be called as income tax expense. Now what we had noted was that these two may not be exactly equal, they may be unequal in some cases. So an example we took was the operating expense, and we saw that this number could be different, and because of this difference and operating expense being higher in tax authorities income statement, we note that the taxes is relatively lower here. So when we had earlier reported 60 to the income, 60 as the taxes, and what we had paid to the shareholders, or sorry, the tax authority, was 30. Remaining 30, which is the liability, because at the end of the day you need to pay 60 but you have paid only 30. The remaining 30, which is a liability, is called as deferred tax liability. And we also saw a case where if the shareholders tax is less than what is paid to the income tax authority, the difference between the two is an asset, because this asset will lead to some tax benefits over a period of time, and hence it is recorded in the balance sheet as deferred tax assets. So this is the concept of deferred tax assets and liabilities. Please do understand this equation. This is extremely important.